Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing direct communication solutions stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. This video is being sponsored by Direct Communications. Direct Communication Solutions simplifies IoT technologies, making them easier to deploy, less costly, and more efficient. IoT stands for Internet of Things. The company is headquartered in San Diego, California, and was founded in 2006. It went public in 2020 and trades in Canada on the CSE, ticker DCSI, and also on the Pink Sheets, ticker DCSX. DCS designs, develops, and deploys end-to-end solutions which improves business efficiencies to better manage and analyze data. In 2019, it launched its all-in-one cloud-based IoT platform. It is currently developing advanced software applications that can analyze and manage the data that IoT hardware has previously just collected. This will provide businesses with real-time data in order to make better decisions about their business. The multi-billion IoT industry is plagued with inefficient and frustrating processes. This company plans to change that. IoT is mainly used for devices that wouldn't typically be expected to have an internet connection and can communicate with the network without human action. An example is a streetlight. If there were cars coming from one direction mainly, that streetlight could be green on that one side and not constantly turn red every few minutes. This would ease traffic. Let's get started with the model. This is a micro-cap company, 21 million market cap. They're trading at $154 a share, and they have 13 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have negative free cash flow every year except in 2019. It was positive $500,000. Net income is the profit and loss on the income statement. That's negative every year except in 2018. Revenue is the sales for the company. That grew a lot from 2017 to 2018, but it's pretty steady after that. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Then below that is their gross profit. Gross profit is revenue minus cost of revenue, and that's positive every year, around $4 million. Then below that is operating expenses. An example is research and development. Below that is operating income, and that was negative every year except in 2018. Below that is the interest they pay in their debt. They paid the least interest in the trailing 12 months. Then other income and expenses, pre-tax income, then net income. And you can see they have negative net income every year except in 2018 they had a small positive. This company is trying to grow its business, so it hasn't hit break even yet. It will take time for the company to become profitable. Right now, its costs are a lot higher, but once economies of scale set in, then profitability comes much faster. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses or generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. And they had negative operating cash flow every year except in 2019. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus capex gives you your free cash flow, and that was only positive in 2019. The company IPO'd in 2020. It was able to generate $1.8 million of cash from that IPO. It's also been using debt to run its business, $1.5 million in 2017 and $1.3 million in 2018. But it looks like they paid down a lot of debt in 2019 and 2020. Let's look at the capital structure. They have negative $1 million of equity and $1 million of debt. Their net debt is $500,000, and their WACC is 14%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $156 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $80 million. We divide that by 13 million shares. And we get a calculated stock price of $6. They're trading at $154, so they're trading at a 74% discount. It's a strong buy according to the model. It's really hard to value a company that doesn't have much revenue and negative free cash flow. I tried to predict how big the IoT market would be and also what percentage of that market they would have and their costs. If you think their future free cash flows will be lower, then your valuation will be lower than mine. But if you think their future free cash flows will be higher, then your valuation will be higher than mine. The stock IPO'd in Canada last year. It looks like it started trading in the US in January. And the stock is pretty flat. It did drop at one point, but it came right back up. This chart is the expected growth of the IoT market by region. The market will hit nearly 3.5 billion devices by 2023. And the biggest part of that market will be in North America. The second largest will be in Western Europe. This stock has gone down 10% in the past 52 weeks, while the S&P 500 went up 65%. The lowest their stock price has gone was 110, the highest is 173, and the stock is trading above its 50-day and 200-day moving average. Since the stock trades on the pink sheets, it has a really low trading volume. Of the 13 million shares outstanding, 7 million are on float, and none of the shares are held by institutions. In the past 90 days, this stock is up almost 12%. While the industry is up 10% and the market 5.8%. In the past 30 days, this stock has beaten the industry and the market. If you invested $10,000 when this stock started trading, you'd be at $8,900 today. The biggest shareholder is a CEO at 45%, then White Tiger Venture, then another officer at the company owns 1.3%. Let's look at their financial ratios. The average PE in the market's 32, the median is 22. PE is stock price over earnings per share. Since they have negative net income, we can't look at the PE. Price to sales is stock price over sales per share. They're at 1.4. So investors are paying $1.40 for $1 revenue. That's a really good price to sales ratio. Price to book is stock price over book value per share. They have negative book value, so we can't look at the price to book. Since they have negative equity, we cannot look at the return on invested capital. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. We can't look at the ROE since they have negative equity. Their current ratio is current assets over current liabilities. They can cover 70% of their current liabilities with their current assets. And their current assets are $400,000 of cash, $2.4 million of receivables, and $1 million of inventory. The company seems undercapitalized. They're going to need more debt or equity to run their business over the next 12 months because they had negative $2 million of free cash flow and negative $2 million of working capital, so they're short $4 million. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 13 companies in the same industry as direct communications. And if direct communications has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They're worse in pretty much everything except price to sales because they're still growing their business and they have negative equity. To summarize, I have them trading at a 74% discount, but it's really risky investing in a penny stock. You don't know which way it could go. You can make a lot of money or lose everything. This company has a really good team and some really interesting products. So I'm really excited to see how they do. I rank their free cash flow as 1 out of 10, their revenue 4 out of 10, and their ratio is 2 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.